Sure. All right. All right, guys. I have been with Pacific Trading Academy since they started almost 16 years ago, and I've been in the business for over 30 years. So it's a pleasure to meet again with you. About a week ago, the Academy contacted me and asked me to do another presentation. It's been a while since I did one. So I thought as we approach the mid portion, the end of the second quarter, the middle of the year, it would be appropriate to kind of take stock and give you my latest or most recent assessment of the stock market in particular. My original title for this, which didn't make it through the editing process, was a review of the rotations for the market, but we thought that the near-term forecast for the market would be more presentable from a presentation standpoint. So I am going to talk specifically about the equity sector in the United States, that is the stock market. I trade the S&P, but what I'll have to say in the analysis and my projections will apply to any of the major indices, whether it's the NASDAQ, the Dow, the S&P, the Russell, etc., all the major U.S., the spiders, and any major U.S., the Qs, etc. And I only have about 5 or 6 slides, so normally for those of you who've heard previous presentations and webinars and so forth, I tend to be too verbose. So I have restrained myself, and by only including 6 slides, the last one being the most critical and for which we will have an opportunity for any discussion if you have questions, I think we'll contain this to less than an hour. But if we have, I'm happy to stay at least an hour if we have any questions that you're curious about and I can address. All right. Let's see. Okay, just a note to give you a perspective on the type of approach I take analytically. Timing should always take precedence over price. I always tell traders when I am in consulting or teaching or coaching, the particular tools and indications and relationships that I depend on to make my trading and investment decisions in the order of importance to me are price, number one, or the trend, I should say. They're one and the same in the way I kind of perceive them. But a very, very, it's by a hair, a thin hair. It's, the horse race is won by a nose, as they say. But from a cause and effect standpoint, certain time periods correlate very strongly in terms of the type of price action and evolution we see. So timing is critical to me, and I realize I'm rather exceptional. Less than 5% of traders worldwide of all the traders. They did a poll many years ago that said, so it's probably more or less the same. Things fluctuate plus or minus a little bit, but more or less there are about 1 million active professional traders on Earth right now, meaning that they earn their livelihood and generate their incomes primarily from the markets and their activity. Of that million or so, less than 5% is, I don't know how they poll this, but approximately it's a small percentage of the total number of traders utilize timing as a part of their analyses to make decisions. I am one of them. I am, I guess, in the lineage of the people like W.D. Gann and things like that. So he is the primary name. So time is and price and their relationships are what I look at in addition to the standard fare of indicators. Money flows towards greatest rates of return. So Marat Baran, who heads our computer department, thought this would be a metaphorical slide to illustrate money flows. And it certainly does. This is clearly a fundamental perspective. Capital flows, money flows, it's a fundamental consideration. Even though I'm a technician and start from a price and time standpoint and all the other standard approaches that are typical of technical analysis, I'm not oblivious. I don't discount all information, whether you depend and start your analysis fundamentally, technically, quantitatively. These are just labels. It's all information. It's the type of information, or more specifically, the source or origin of the information that determines what category of analysis you employ to make your trading decisions. Dan's asking, do I use volume? I take it into account. Dan, good question. If you had asked me that 15 years ago, I would have said that volume is the key to everything. I'd probably read a number of books and was focused on volume, and had probably talked to some wise sages who told me about the importance of volume and the fact that it provides the electromotive, the EMF, if you will, the power. It is the voltage of price action. And I still believe that, but in the hierarchy of tools that I use, it's not of paramount. It's not in the top 5 things. It's something that I look at. I'm aware of all the standard, traditional, typical relationships and correlations that one can learn and understand and identify in terms of volume as it relates to price and price evolution and motion. But if you ask me, so I'm not aware of it. I'm not paying attention. It's not that I'm not paying attention to volume. It's just that I think there are other attributes and features of market behavior that indicate and let me know and inform me what things like volume price relations do, and then some. So I no longer have the degree of dependency on volume per se as I once did. But it's not that I'm not aware of it. Certainly I am. Okay. So money flows on that level fundamentally, move markets, or have the potential at least, and money, and as an overriding backdrop to everything I'm going to say, because I'm going to go from the big down to the small, the technical, the going deeper on underneath the level to kind of highlight why I believe what I believe will occur with the stock market. On the more superficial level, up at the ground level where news is present, capital flows are a primary driver. And if we understand what's behind capital flow or money flow, is this internal or intrinsic quest that money or energy has. I use those two terms interchangeably. I think there's a rough equivalency between money and energy. If you think about it, I don't think it's too profound. I think it just is that. It has this quest, or there's a compulsion implicit in what money does or energy does to find greater, to maintain its energy. And so money flows towards the greatest return. That has the effect or net impact of maintaining its potential energy or power or capability, spending power, monetary purchasing power, if you will, by analogy, and to increase it. Similar to power, if you think about it. The old cliche, individuals, entities, nation states, etc., that are in power, first and foremost, their primary mandate and statute is to maintain, and secondarily, increase. Money does the same thing. So if we think of that as a big, broad backdrop, as a concept to understand how the capital markets work, as a global macroscopic kind of idea within which we kind of generate finer, more detailed, specific projections, it kind of serves me well. So that's clearly coming from the fundamental front. So as evidence to show definitions, labels, technician. My area of research is timing. That's kind of in a gray area. It's not specifically, precisely speaking, purely fundamental on the one hand, but it's clearly not technical. The primary thesis of technical analysis is that all information that you and I, the market speculator and investor and operator, needs is contained in the price. All information is implicitly discounted in price. So that's the primary tenet and underlying theoretical foundation of the technical approach. I buy that. I use that. I depend on that. Having said that, I just said a minute ago that I place a lot of emphasis on timing. So timing is a feature, or time, if one can think of what that is. What is time? Someone asked, I don't want to go too far off here, but someone asked Einstein to define time, and he said that which can be measured by a clock. It's kind of an indirect definition. If you think about it, the definition of time is not all that easy. We all know what it is, but it's so pervasive, it's hard to create or derive or come up with, if you will, a precise definition. So I'm going to stick with that thing or that entity which can be measured by what we call a clock or a timepiece. All right, I would say a clock. Okay, so stock market rotations. This is really the meat. Yeah, I do use volume, Dan, if that's the last question, but it is not the first. It's a tertiary or latter consideration. To the extent to which I incorporate a volume relationship relative, I assume, with price or any other component of market behavior, is going to be contributory, meaning that if I have three other things, let's say, for which I place a greater amount of emphasis, i.e. price or trend, timing relationships, or a time period that's ended, let's say, for example, or a cyclical component, or a time projection that's very specific and for which I have a lot of confidence. And then lastly, thirdly, on my totem pole, is the most robust and helpful price descriptive model I am aware of, which is the Elliott principle. And I felt hesitant to say that because I know there are so many critics of Elliott and his ideas. And a lot of that criticism is valid. A lot of it, I think, is not is off the mark. But that's neither here nor there. For me, those are the top three models or ideas or theories that I apply. So if I feel comfortable in a particular forecast on a market based on primarily starting with those three things, and then I look at volume, and the volume relationship present at that time happens to be in alignment and agree and congruent with what those things or similar modalities indicate, then certainly the answer is affirmative. I do consider volume in my analysis. To the extent it would generate an alternate or contrary view, I'm going to pay attention, I'm going to take a look at it, but it's going to have to be a very salient contraindication, say from something like volume or open interest or its cousins or analytically or something like that, to sway me from a consensus viewpoint that things like the pure trend analysis, the Elliott structure and count that I've derived, and my time projections have previously generated, to alter that. Okay, so here specifically, you see on the screen currently a daily chart of the current front month S&P. And here's the primary starting point of what I want to convey, the meat of today's presentation. So let me indicate. These vertical lines indicate theoretical time projections. We've just passed one. We are kind of right in the window or just leaving. There's the approach and then there's the exit of an orb. It's when people who do astrological or astronomical or financial astrology, if you will, market timing based on astronomical or astrological cycles, there is what's referred to as the orb of accuracy. The orb refers to when a particular cyclical event is occurring. There is the actual moment of its occurrence, but there's the few moments, or the approach and then the exit. And typically the move that these type of cycles indicate they have the greatest impact and surge of volatility, if you will, on the approach versus the exit. But anyway, it's almost as if it's a model for potential energy transforming or evolving or shifting into kinetic. Anyway, here's what I want to convey, the critical components for those of you who are new. I don't want to get too far off on tangents here. We have just, my last projection for the stock market in terms of a time target was June 12th. So that was just 3 days ago. Today is Wednesday the 15th, the 12th was Sunday. In principle, whenever I derive a date that for which the market's not trading, even though some instruments are trading partially on the weekend, on Sunday, there's typically little volume. This screen was printed out. This is the daily chart again of the S&P, if you can see up here in the upper left-hand corner, September contract of the E-mini S&P, and you can see it's just a daily graph or plot. Last night, so it doesn't reflect today's action. Today we closed basis this contract. I didn't have time to update the slide or put in the new slide and be present and timely for the start of today's presentation. But yesterday, you can see we were at 2062. If you probably can't see that or read that because of the resolution here. I can hardly see it, but we're kind of right. We're at 2063 a minute or so before I checked in with you and turned into the website here to start and commence today's webinar. So we're kind of right where we left off at about 10 o'clock last night when I printed this out and included it in the slideshow. 2062 was last night at the time I printed this screenshot. We're at 2063 right now, although we surged higher. We got up to, I think, 2078 or so in response, more or less as kind of like a knee-jerk response to the Fed and Janet Yellen's press conference concerning the latest thoughts on the central bank. It went up and down. So we had a large range. We kind of have a key reverse. Well, I'm not sure if it's a key reversal. I don't, because we've been coming down since the top there on the 8th of June, which was a week ago today. And that, if you can see my cursor, this top right here, this little pivot point is a week ago, last Wednesday. That's June 8th. So in the net, we've been declining. I actually, on last Friday, got short the market, and again, procedurally, just so you guys know and can put into context what I'm about to say, I exited my short today and got long. I'm long in the S&P from 2074, I think, 2074. Okay. So, again, to reiterate, I did not put in a line to illustrate because it's past, and I want to go have a forward look or a forward viewpoint here. But my most recent turning point that I projected was June 12th, which was this past Sunday. So effectively, the practical application would mean it was June 13, 2 days ago, where I was expecting a reversal. I still am. Whether or not we'll see that remains to be seen, but we shall see. So here's what I'm expecting. This line, this vertical line, is my next projected time point. June 22nd, which is a week from today, next Wednesday. So it's interesting. So at the time I was putting this and thinking about this, I was last night in particular, and up through the moment we commenced, my projection was that the market, in all probability, in terms of tracing out or presenting a hypothetical trajectory for price action in the stock market, we would drop into next Wednesday. In other words, the overall trend or current price action would persist more or less unabated until we reach the next time for which I have projected. The significance and your takeaway of interpretation relative to each of these vertical lines is, and I'm being a little simple here because it's not quite precisely gospel, but it's more or less for the sake of what I want to convey in today's presentation. Expect that each one of these lines and the point in time at which they are presented in the horizontal timeline correspond with a U-turn in price, a trend reversal. So if that's the case, more or less, and again, this is what I was thinking last night, I was expecting the market would continue down into, or through, rather, I should say, moving horizontally, thinking in terms of the run time for a given move to last, through next Wednesday, June 22nd, at which point the significance of this line is this would create a reaction, or we would see a corresponding response or resonance on the market to create a shift in direction. All right. And then the next time I projected is July 7th, indicated by this line, and so on and so forth. The subsequent projection, July 31st, the end of July. And then I've already projected out as far as 9/19, and that's where I left it for today's purposes. All right, so essentially these lines, the last one again being just 2 days ago on the 13th, June 13th, the most recent, so we're kind of still, we're on the on the right side of the orb, if you will. There's the entry to a market turning point, and there is the exit. We are leaving the orb of influence, if you will, that I project for the most recent projection, which was June 13th, just 2 days ago. And as such, I would expect a change of attribute or character of the market with response. For how long? Until we reach the next projected time point, assuming this is, we see price action and behavior adhering to my theory and my theoretical rotation projection. June 22nd. So essentially, more or less, my view currently is that I would expect continuance of price action between where we are at this moment. This chart reflects yesterday's action through about 10:30 at night, and a week from today, June 22nd, after which I would expect the market to, let's say, in a simplified way of thinking of this, reverse, stop going down and move up. For how long? Through the next time point, July 7, after which I expect it to turn around and come down. For how long? Through the end of July, July 31st, and so on and so forth. So think of these vertical lines more or less as simply my rotational guide, if you will, my tour through market land, through time specifically. But they provide a rotational, more or less, timing guide, a guidance system. They don't tell me anything by themselves in price. These lines don't indicate or imply in the slightest, if they do, or if they could, anything concerning price. That's left to alternate models and ideas and relationships. But by themselves, these dates merely indicate the point or window in time within which we can expect a greater than average probability for U-turns or trend reversals to ensue. And as such, as a complement to whatever indicators or other types of tools and relationships you focus on, this could serve to assist us in navigating and planning and creating strategies to ramp up our odds for generating profits. All right. Okay, any questions on that before I shift gears here? So far so good, guys? All right, we still have audio and, all right, no questions. So wait a minute. Do I use volume? No? Okay, good. All right, completely different idea here, folks, to see if I can integrate different ideas and see if I can make sense of what the rotational set as that the previous slide, oops, I jumped ahead. Let's back it up. Yeah, I want to see, this is my set of rotations providing more or less an indication of timing. Now, how do I determine someone's asking, how do I determine the vertical lines? Blake, good question. Well, that's what I've spent 30-some years trying to figure out. But that is the question. To kind of, whatever it is, and however I do so, I make sure that to the extent I have different ways to generate any one of these lines, I have a correspondingly increased or greater amount of confidence in that any one of these dates will be a reliable point at which the market does take notice and respond and turn around. And that applies in general to any type of analysis, be it price or time, but it's a very good question. How does one project in advance with any amount of reliability when it is a market's going to trend reverse, form a top or a bottom? Whatever you do, however you do it, you should not, in principle, and this is my constant kind of pedantic mantra, don't ever depend on any single tool, indicator, relationship, model, you name it, Ouija board, etc., unless you find something that's perfect and you can test it and prove it and have a track record to statistically, numerically, objectively give you confidence that it is perfect. Anything less than perfect, by definition, my working and analytical approach is to apply or generate a type of information, in this case timing, via a series of different, the emphasis being on implicit difference of approach. You want to raise the bar and make it more difficult for you to generate the same type of, in this case, timing information, but it would also apply to price as well. But when, in spite of the increased difficulty that you purposely or by design render your capacity to come up with a given singular type of output of information, is the extent to which you can have a commensurate degree of confidence that that will, be a relevant piece of information as far as the instrument you're studying and tracking. Clearly that's the case. So not to be facile, Blake, I use everything, in principle, and it's a good question, it's a very appropriate question. This time, the time projection for June 13th, 2 days ago, I had over 90% confidence. My degree that the market would respond in turn or change in response to it. That remains to be seen. I am seeing price action consistent with it, though, so far, just so you know. That may or may not be obvious to you, and I'll be happy to elaborate in a few minutes. I don't want to get too far off. I want to complete the presentation. I'll have plenty of time for questions here. But so, for example, I have a lot of I had and still have confidence in our what I consider still to be, even though we're ebbing, we're on the right side. We're leaving the orb of influence of my June 13th, 2016 price or time projection. And as such, we'll leave its influence entirely, and we will begin to approach ever more incrementally June 22nd, a week from today. I don't have as high a degree of confidence on next Wednesday's time point. I have about, I would say, 70% confidence that the market will respond in an obvious, salient way that's meaningful. So there, the way that what differentiates my degree of confidence on a numerical sense as to what time target has versus what a time target may influence, the influence or the amount or magnitude of influence a time point may have response and the market's response is typically, and again I'm simplifying a little bit, a consequence or a function of the number of different approaches or relationships that I have looked at that indicate a similar date, a similar time point. By the way, let me just say, I said date. You can, the same concepts and models and relationships I look to that enable me to generate time points, say on a daily time frame, out over for periods longer out into the future, say days, weeks, months, etc., quarters, etc., however far out I choose to project, will scale for a short term, intraday. So, but I'm calibrating everything in terms of minutes there. Most 90% or so of the tools and ideas and models that I utilize to generate my longer term forecast, once I adjust them and scale it for intraday trading, if I'm a day trader in the E-mini or whatever, similar ideas, for the 90% of them will work. Some don't, some are time window specific, but for the most part, because the fractal structure of markets, the majority of the ideas and relationships are going to transfer well as you shift through from one time horizon to another. All right, so I am indicating clearly discrete differences in the degree of reliability I place on any one of these respective time points. I don't expect as much. I think, in other words, June 22nd, next Wednesday, is of lesser significance with my expected response by the market. Nevertheless, it's something greater than average. I would again assign it roughly about a 70% degree of reliability unimportance. Contrary to that, July 7, I expect to be back up, 85, between 85 currently, based again on the number of different ideas that happen to give me July 7 or thereabout. So that's of importance. So I can kind of know in advance how much confidence I can have in any one of these expected responses by the market as you get more and more proximal to a time point. All right. And then similarly, I have a lot of confidence for way out here in 919. So, all right, so that's the rotation in time. Again, just up. Okay, so if we're going down into this point, I would expect the market in a qualitative directional sense to shift, go up. So we're moving down into next Wednesday, up into July 7, down again into the end of July, July 31, and then up again through kind of third week in the fall, September. So we're going down, up, down, up, down, up, down, up. That's the rotation. And again, it doesn't say anything about price, but it does provide at least a template of plausible rotation on the timeline. And now the idea is to try and see if we can, through other models, other forms of analyses, see if we could put together and in aggregate a more complete picture of plausible, finer estimation of, you know, what the real world may end up doing, a hypothetical projection. So, in that note, this is the COT, Commitment of Traders Report, the same market, just a blown up, little different look. E-mini S&P yesterday printed out. You can see we had an inside last night. We were at we were at 2066 roughly. We're at 2063 right now, or as of the close of the day session today. All right, someone earlier, Dan, I think, asked me about volume. So one of the reasons, to your point, how do I determine, okay, let me, yeah, I think I got that. Notice recently from the top, this is June 8th, a week ago, the net trend through yesterday and actually through right now, through today, the close of the day session today, the overall trajectory is lower. While that's going down, the volume is increasing. And so that would tend to suggest a persistence or a continued follow-through of the similar or same type of price action. By itself, in this case, for this market at this time, that's clearly, in and of itself, bearish. And that's consistent with my theoretical expectation that the previous rotational slide, my time slide, was showing. I'm expecting further, more or less on an assumption that the market will turn in the next time point. I can assume between the preceding, you know, the market is the sandwich in between the two time points. You start with the Newtonian assumption of continuance unless something happens that would perturb or disrupt that system. Systems of all types, static and dynamic, like financial markets, tend to, they're most comfortable, the lowest, they conserve the greatest amount of energy by doing the very same thing they're doing until something from the outside, external, perturbs the system sufficiently and in the right way to create a change. So think of these vertical lines as change points. Okay, they're the nexus points of change. So more or less, on a simplified assumption, I expect the market more or less theoretically to persist doing what it's been doing until it has a reason to change. That's the point of next Wednesday, June 22nd. All right, my volume and open interest, the volume of these vertical red lines, it's going up, suggesting that there's increasing volume which goes hand in hand. It's acting in collusion with the price. So that's certainly price bearish, suggesting we'll continue to offer the price down. This lavender or purple line is open interest. It's rising. It's telling me the reason why the market's going down in the net is that there are new traders coming into the market, and they are more in the net. I'm oversimplifying again, but open interest is an indication as to why a market's doing what it's doing. In principle, there are always a multiple of reasons, but I want to look at the macroscopic for a moment. Rising open interest says that the reason the move is propagating, if it's rising, is it means it's in addition. Traders who were previously on the sidelines are now entering in, establishing new positions, as opposed to a liquidation, which would be reflected by a falling open interest line, indicative of previous traders or traders leaving for whatever. It doesn't tell you the motivation, it just says the net effect. So this is all bearish. These two, the fact that while the price from last Wednesday through today is declining, in and of itself indicates that sell orders are predominating. The bears are winning the tug of war, figuratively speaking, versus the bulls. But the reason for that is substantiated by this purple line. Why is that? Or what more precisely is the cause? It's new sellers coming in as opposed to old buyers liquidating. That would be another reason that could have a net effect of pushing price down. The fact that this line for the time period, apples to apples, is coming down while the price is going up while the price is coming down, is telling me more precisely what's the causative agent or factor behind the price dropping. It's new sellers. That phenomena tends to be more chronic than liquidations. Liquidations tend to take less time. So it's more bearish than it would be if this purple line were going down. It's not. So that's somewhat bearish. That's consistent with my expectation for the possibility of further declines for another week through my next projected time target of next Wednesday. All right, all of that is peripheral. The real reason I notice the title up here, COT, Commitment of Traders. That look change your focus to this stuff down here, guys. This is what I really wanted to show you here. This is striking. It's interesting and striking and it's a little different. It sticks out because it's rare. It doesn't happen, but at maximum for any given market, let's say, 15, 20% of the time. Normally, okay, let me clearly, the red line here, this is just a graphic representation of the net long or net short positions by the three primary constituents of a market, the small traders, the large traders, and the commercials. Large specs, small specs, and commercials. The red line are your commercial over going back a year. The green line is your institutional large traders or large specs. And the blue line, if you can see that, is your small traders. Normally, 80% or more or so of the time, whatever it is that the red line is doing, the green line, the large institutional, big money, is the polar opposite. Graphically, it would be a mirror image. For most markets, most of the time, that's what you see in place. And that's the state of the affairs in terms of a dynamic system, a situation that's constantly changing. At any given point, 80% or so of the time, as a rule, you will see that relationship in effect. Whatever the red line is, you will see the opposite. You can expect a mirror image along 180 degrees opposite shifted around that horizontal axis. Every now and then, you have a different situation, which we have at the end. This is basis for last Friday's most recent Commitment of Traders report, which is simply an accounting by the U.S. government, the CFTC, of the net long and net short positions held by these three primary constituents of the market. Notice that the commercials, now, they're in a net long here, while the blue line and the green are kind of polar opposite. It's relatively rare. That's my point. Whenever that happens, it lends added credence. It amplifies whatever it is the net position of the commercials is, the red line. So this is ostensibly quite bullish. Now, in the scheme of things, it could be more bullish. The reason I say that is if this red line were of the greatest net long position that they've been in the last 6 months or a year. It's not. However, look at yes, on that count, it could be more bullish. There's always a continuum of assessment and states, but the commercial position has been evolving in the last month. You can see we're currently for 1 month, where the commercial line has increased they went from a net, just slightly net short to an absolute net long position here. While again, that's somewhat significant, it's bullish. Not enough to place a trade to go long the market, but it is potentially as a harbinger, as a leading indicator of what I can expect the market to do. It's telling me that the commercials are expecting the market to go up, to stop going down and to start go up. Let me simplify it, make it plain. What lends and adds credence to this is that simultaneously the blue line, who cares what, well, for our purposes now, I don't care what the green line is doing. I'm interested in the blue line. Why? The small trader, they're wrong most of the time. 90% of the time, they're wrong. So if they're opposite what it is that the red line is doing, that really suggests watch the market shift sooner rather than later as a timing mechanism in and of itself, what it is that the net position on the part of held by the commercials. So although currently up above, clearly from the trend standpoint, the market's coming down, interpret what the red line is doing as the commercials do. And by the way, they pack the punch because they create the volume for 80%, 70-80% of all trade volume is due or originates with commercial activity. You and I and all speculators are the counterparty. We create the liquidity. That's the economic justification for trading, or speculation rather, I should say, not trading in general. But okay. So this is of significant importance. The whole point of raising this or presenting this, including this in the presentation today, is to indicate the correlation that possibly could occur. The uncertainty, the question mark, and looking at the COT report and whatever it tells us, what it tells us is what I just stated. It's potentially bullish in the future. What is uncertain is the actual how can I tighten that up and be more precise? Is it going to be tomorrow, next week, 3 months from now? That, in and of itself, the COT data does not specify the timing with which we can expect the price action to turn around and move in alignment with the direction of the net position of the commercials. It just presents a qualitative indication as to what the future holds. How far off into the future that future is the report does not by itself tell us. So my attempt is to try and coordinate that with this. Could it be congruent with a week from today? I don't know, but I don't know that it is, but it could. It makes sense. If, to the extent the market responds and reacts in the manner that we would expect it would when it reaches or has run its time in a particular type of price action, that would make sense. I cannot rule it out. I'm not suggesting you place a trade solely on that, but it presents as a possible hypothetical scenario, and so we're looking to theoretically, given different modalities, different relationships, see if we can find a plausible explanation that meets and fits with as many different models as possible. And to that extent, we can either increase our confidence or decrease our confidence accordingly. All right. Last slide of interest. This is the working slide. I want to put it all together. So again, just by quick review, the trend is down, that's bearish, supported by rising open interest and rising volume. That further adds to the bearishness. However, that's the present. The previous slide indicates it might persist through the next turning point, June 22nd. So that provides a timing element and a possible indication as to the duration for which I might expect the current move to persist through the next time point for another week, plus or minus X amount of, a day or two, let's say. That makes sense. I'm at the current state of affairs is we expect the system to maintain its current type of behavior, which is down. That's supported by rising open interest and volume. However, we've got a contraindication, but it's not specific to the present moment, but rather it can serve as a forecast or a leading indication of what might occur in the future. Great. We have an idea. We're anticipating change. Now we want to fine-tune that. My previous slide indicates a possible duration for which the current market might move the next week. Why? Because that's, if you believe in the relevancy of this line, it would indicate a possible point of change, a switch at that time. And so we might surmise the market might continue doing what it's doing for how long? Until it reaches its turning point. It's, the turntable for which it will do something else. All right. So on that hypothesis, I just graphed in or penciled in some trend lines to indicate maybe it would go down into, here's the corresponding wave count, just to add and layer in another alternate idea. Here, this bottom right here is January 20, the beginning of the year. Let's say that for those of you who understand Elliott theory, you might follow me with this. Here's a plausible description, or count as they call it. Wave number 1, correction 2, wave 3. Here's an A of the 4, the B of the 4, the C of the 4, and then a 5th wave, completing completing the 5 waves of the bull portion of an 8-wave cycle, for those of you who are conversant in Elliott principle. Okay, so what happens if this top here on our chart was the end of the initial set of the bullish portion of the cycle? Then what do you have? Theoretically, an ABC correction. We have price action that's consistent with that. This could be the A, the B, the C, right here. This bottom right here, that was May 19th, if I recall. I forgot the date, but I don't think so. I think that was kind of like the 3rd or just past the middle of May. May 19th is the end of the one cycle that began at the beginning of this year. 1, 2, 3, 4, 5, ABC. We have structure that's consistent with that. I'm not submitting or surmising necessarily that's the absolute perfect count to which the market is moving, but it is structurally consistent with all of the rules and tenets of the model for the most part. All right. If that's the case, theoretically, if this bottom that came in last month, the middle of May, May 19th, is the end of a cycle, it must be, by definition, theoretically, in accordance with the Elliott concept, the start of a new bull market cycle. So 1 is last Wednesday's top, the June 8th top. Possibly. If that's the end of wave 1 going up, it must be the start of wave 2. Those of you who are conversant with Elliott know that second waves tend to be deep. How deep? Well, they can retrace 100% of wave 1. If you think you're in a wave 2 and it retraces or it takes out the start of wave 1, you've just broken a rule. That would cause at minimum a hesitation. So far, we notice where we were and where we are right now. Again, we closed 40 minutes ago when I started today's presentation. The close was about 45 minutes, at 1:15 Pacific, 4:15 Eastern, right around the current where we were at last night. We're at 2063. I'm not sure what's happened since I got on the line with you guys, but more or less we're in the same area. And I put some fib ratios in for those of you who know that. We're right in a 50% area. We got yesterday's intraday low, got close to the 62 fib level, 61.8. So, and then I put the Gartley in here, the 61.8 and 70 range, just for purposes of context to give you perspective on where the thing could go. Okay, but again, I'm expecting we might, theoretically, if it's a wave 2, let's assume it went to the extreme of the Gartley, the 78.6 Fibonacci level. That is amount of retracement of the move up from May 19th bottom, where letter C is, up to the top of June 8th, last Wednesday. It's not totally inconceivable beyond the pale of consideration to expect the market could, in the formation of wave 2, trace down to this price level, which is I had to move my panel so you could see the scale here, 2035 area. So we're trading right now at 2063. If we continue to see the market move such that it retraces about 78, 79%, that would bring you into the 2035 area basis, the September S&P. And curiously, oops, went to the wrong slide. Curiously, I would be, I don't know if it's going to be purely linear, Newtonian, for every amount of every instant in time. We're going to go a fraction or a point or a tick in price. Rarely in the real world do you see linear type of price action. That's the attribute and the aspect of financial market analysis that it makes it so complicated and endearing. It's not that you have mixtures of linear action and nonlinear, and it's who's to tell when and where and how it will manifest. But overall, on average, this is a plausible scenario. You could have, assuming we went down to the 2035 area, and this line, again, I have my dates indicating the time, what each vertical line corresponds to. June 22nd, a week from today, next Wednesday, might conceivably correspond to the end of a correction, which, if it did, to the extent the market played out this hypothetical projected theoretical script, would be an optimal time from which to get out of shorts and go and reverse and go long, marking the end of correction 2 and the onset of wave 3. What do we know about wave 3s? Elliott said they are wonders to behold. I just thought that gives me a break to think about. That would be why, that's where it's the second best place theoretically to get in a market cycle. It's a close second to trading the reversal that ensues after a wave 5 has occurred, but that's another thing. But statistically speaking, third waves, whatever the rule is, they tend to be the longest, the powerful, the quickest, the greatest, and as such present viable opportunities to generate optimal returns. Okay. So what's my window of opportunity theoretically between next Wednesday, June 22nd, this vertical line right here, where number 2 is, and number 3, July 7th? That's good. Limited time. It's a narrower band of opportunity. Lessen the market exposure. The less time you spend in the market, the less risk you're at, all things being equal in an absolute sense. But that's a time consideration. What about a corresponding price target? Third waves are 1.618 conservatively. Speaking of wave 1, well, what does that bring me? 2193 or so, or just between 2190 and 2195. Somewhere, let's call it 2192.5 to play it safe. Somewhere in there. That's a conservative estimate. And we might see the market there on what day? What day is number 3? July 7th. So that is the, what is that? Like the first full week in July. So that would give us an idea of a plausible scenario. After which, if the market completes wave 3 there on July 7th or thereabout, What ensues, theoretically, based on the Elliott model? A correction, wave 4. Wave 4s tend to be shallow in terms of price retracements. The maximum 80% of the time is about 38%, thus the 38.2 fib level. Can you see that, folks? Hopefully you can. 38.2, that would correspond with a pullback to a price of about 21.34, let's just say. So here are the rotations. We go down, we go up, we go down, we go up. And then I've overlaid some, based on some, everything I know, and highlighted for you are some of these obvious fib relationships. I'm being a little simplistic because I'm not taking into account other factors, but for the sake of clearly conveying a clarity of plausible trajectory and price action in the subsequent rotations and how they combine and connect and dovetail with the timing is what I want to effectively indicate and show. Okay, so if we, say on or around July 7, traded up into the 2190 to 2200 area, it's not, I would say more often than not, third waves have a tendency to exceed their theoretical. So this is a conservative. That 2192 area, or between 2190 and 2200, is probably a conservative estimate. It's also based on the deepness, the depth with which we end up wave 2. I assumed a kind of a maximum or a more maximum. And again, implicit in everything I'm saying are laden, filled with some assumptions. I don't know for certain how deep wave 2 will go. For all I know, it ended today. And as such, that would have the net effect of shifting everything forward or closer. We would shift everything slightly to the left, so that would bring June. Maybe my projected time point for next Wednesday will come in, this Friday on the 17th, or maybe the 21st, or excuse me, the 20th, this coming Monday, which by the way is the solstice, the summer solstice, which I mention it only because financial markets in the U.S. in particular, I don't know, I've forgotten, and I have forgotten, but I know that the stock market, the currency markets, interest rates, bonds, T-notes, 10-year note, etc., all to some extent are influenced by the calendar quarters, the solstices and the equinoxes. So is it coincidence that my time point, my next projected time point, for which I have, say, about 70% confidence, will exert an influence on financial market, the stock market in particular, is 2 days after the summer solstice, which is a completely different cyclical factor, for which in particular the equity sector, the interest rate sector, the financial sector at large, anything that's a capital market sector embedded within our economy in which money is the primary instrument and energizer, is influenced by the, so the close proximity of Monday, the summer solstice cyclical point, and my theoretical projection of the 22nd by other factors, to that extent they may be one and the same, and it's possible, allowing for the fact that maybe with the Fed announcing, what they did today, for those of you who pay attention to that information, might be a little translated to the left or the right, but we have to allow for it. But the template here is merely a starting plausible hypothetical template. We have to embed it with the idea that it's not set in stone. We have to apply it and think of it with respect to how the market moves, with an immediate point of flexibility. We have to adjust it accordingly, given every moment, every hour, every day as we move forward. Okay, but it's nevertheless a starting point of structure by which we might determine, to what extent, how closely does the market action moment by moment hew to it, or alternatively make excursions away from it, and we make adjustments as we progress, and additional trade is traced out on your screen. All right, so again, our next time point up here, coming in on the date of July 7, could hypothetically correspond to a big surge, reaching and establishing new all-time highs in stock prices in the U.S., which might form or occur or manifest in that first week or so of July, is a plausible scenario that fits and agrees and is consistent with both my time projection work and my Elliott work, and a host of other factors that are not as critical but that support that hypothesis. Okay, after which you'd expect a correction. What do we know about create the correction fourth wave? They tend to be shallow in price terms as a percentage of the preceding wave 3, maxing out at about 38% most of the time, 80 or 90% of the time. If that were to be the case, I could see the pullback into an area probably not much deeper than about 2130. I'm projecting about 2134. And the time period, I have an interesting cyclical time point for which that rotation might affect, corresponding with the end of the wave 4 and the onset of the next impulsive wave 5, the end of July. So we've got about a 3-week runtime, larger as I might expect that for the runtime from the end of correction 2 through the end of the impulsive wave 3. All right. And then the final impulsive move marking the end of this cycle, the bull phase of the cycle, coming in at the 3rd week of September 19. You see, and my theoretical, that would be a 5th wave. Theoretically, 61.8 or 62% of 1 through 3 brings us to a projected price target somewhere midway between 2240 and 2250. We're a long way from that now, but we've got a lot of time to cover. So these are the rotations with the overlap of a plausible wave description or count suggesting a hypothetical scenario. We allow for some adjustments, but it's a starting point of analysis, folks. Any questions I'll be happy to entertain based on the picture and the analysis, guys. If you have any, I'm happy. Yeah. No questions. I hope hopefully you're able to hear and see. Any questions, guys? I think we've got a few minutes of time left, so I can still entertain any ideas if you have some. If not, I've taken up the hour or so. Normally, yeah, it's actually 1 hour exactly. Normally, okay. Someone has some questions. Oh, Blake has a question. Let me see if I can adjust it. How do I know the change of behavior is taken? Good question. I don't know that one knows for certain under any circumstances, but by establishing some acid tests. For example, I use what's called a price spiral method. B.J. Howard developed it, I don't know, 20 years ago or something. It's very quantitative, it's more objective than but it can be applied along with other ideas. But, I mean, it's a good question. When markets move certain magnitudes of motion after a turning point, let's say, if you understand Elliott principle, when does one wave end and another begin in the opposite direction? Well, no one knows for certain, but we use certain criteria that serve time and time again historically. History tends to repeat, and as it's not perfectly, but more or less often we see a semblance. When you have a relationship that you've seen and observed, X% of the time, it works 80% of the time, let's say, over a trial of lasting 200 years, and in that window of time you have, X number of samples. It's a sufficiently large, statistically significant sample set for which you can establish confidence in the results you get. It's that type of things that you would look at that would help one to make a decision as to whether, for example, a given wave is ended and the subsequent wave has ensued. But that's one way, but again, in principle, relative to what I mentioned earlier, you don't want to reach a conclusion, make a trading decision, much less establish a position in a market with your actual hard-earned money on the line based on one indicator. The exception being if you had clearly identified and knew about the only perfect indicator. I always tongue-in-cheek tell people, if you find that holy grail, that perfect equation or relationship, and it is truly perfect, whatever you do, don't disclose it. Keep it to yourself. Capture the entire wealth of the universe, of the world. And then if for whatever reason at the end of your days you decide for posterity you want to bequeath it to your loved ones or to posterity and the rest of humanity, do so. But barring that, and I even jokingly tell people, if there is or was or is present some alien technology, I grant that there are things out there that I may not be aware of. Very few. I'm joking somewhat, but no, kind of meaningful, because I make a point of trying to stay on the precipice of new ideas and new concepts. This is a business speculation where nothing is outside. There are no boxes to break the cliche. So bottom line, it's the proof is in the pudding. If it's effective from a consistent capacity to generate and optimize return on investment, it's worthy of a further review and consideration to possibly integrate it to your overall analysis. Bear in mind, everything I've said today is analytical. That in no way is sufficient in my estimation, and everyone I talk to and teach and have worked with over the years know that it's important. This is just the analysis part. That's the fun part. This is the wild, wild west of investing in speculation. The mundane stuff, to me, in the spectrum of what's critically integral and relevant for as far as one's financial success, has nothing to do with what I've just talked about for the last 60 minutes. Very little. I won't say nothing. Every bit. Everything we've said and everything else I could or might not say that would take me an eternity to even think of, much less verbalize, is just analysis. It's what most people think is all that's necessary. How incorrect. I was one of those people at 24 years old. The most important elements to be profitable as an investor have nothing to do with anything I've just said, but have everything to do with what's going on, your internal state, what we put in the umbrella of topic of, trading psychology. I often, if you go back, folks, to the previous slide, okay, this is what it is, and its efficacy will bear out or not, one way or the other, with the passage of time. We will see how accurate this projection is, as this template is, and serves as a theoretical forecast. It either will be accurate to some extent or not. That is what it is. It's just a forecast based on varying models that have come together, for which I have a good amount of confidence. Much more important than this is, however accurate or reliable it proves to be, even in retrospect, it pales in significance in the bigger picture of what it takes to be successful as a trader relative to what I'm not saying, what's not included on this screen. It's the uncertainty. The dates that my tools are not presenting on my analytical radar screen. Each one of these dates, June 22nd, next Wednesday, July 7th, which is 6 or however many weeks out that is from now. What is that, about 4 weeks or no from now? Then the subsequent time point, the end of July, July 31st, and way out into September. They are what they are. They will prove to be of a given amount of reliable or lack thereof. What bothers me in the challenge of trading analytically, not even taking into account the emotional responses and the feedbacks and the complicated loops that as human entities we have with financial systems and energy in the market that's evolved and that flows as a result of all this activity, analytically, just on that front, and that's paling in comparison of significance front, is the stuff I don't know. Like, how do I know that there's not another pivotal interim turning point somewhere in here, or in this space, or tomorrow? So, coming full circle back to my point, suppose there's this alien technology out there that's perfect. It perfectly understands and sees the future. You have the true crystal ball in a figurative sense, let's just say. Here's why I don't think for number one, if you had it, even assuming that's the case, I would submit to those who are paying attention, it's not pervasive. Why? If it were, history tells me that perfect knowledge tends over time to be perfectly acquired and received and disseminated. And as such, everyone, more or less, by virtue of the definition of what it is we're here for, we're trying to generate an income stream and keep it flowing and magnify it and increase it, make it as large as possible. We want to make as much. Larry Williams said the most important aspect of this process of investing is watch your equity curve or chart it. We want to see if it's rising over time consistently. Whatever you're doing is successful by definition. At the end of the day, that's all that matters. All right. Let me get back. I don't want to get too far. I was just making the point, to the extent there is this perfect equation or system or relationship that's out there and that is known, let's call it alien, to give it a title, I would submit it's not being utilized consistently, because if it were, you would see a disintegration of the financial market structure. Stocks, bonds, commodities, forex, you name it. Any freely traded market would no longer freely trade. It would break down. Who would be the counterparty? the market maker. There needs to be sides by definition in this process. The irony of one of the important, fantastical, absurd ironies, if you will, of this business is we don't have perfect information. We don't have perfect knowledge. And that's what allows for the ongoing evolution of what it is we do. So it is a relative, I find myself somewhere in the relative hierarchy of traders who either know what I'm doing and make money or don't. And it's an ongoing dynamic process. It is fascinating. Anyway, how do I know when a change of behavior is taking place? Well, you approximate that perfect state of information, again, based on a set of criteria. For me, it is, whatever it is, again, Blake or Dan, whoever's asking the question, it should not be based or predicated on a single modality or indication. It could, but you're going to improve your odds for reliable accuracy on any decision, knowing when a move has begun or changed or switched or something else. Any aspect of this decision-making of investing based on a set of very, very, very different criteria. And so you're not going to get all that frequently consensus view. When you do, you have correspondingly increased confidence because you know that you've made it difficult for the aligned view of connection to manifest and bubble up to the surface. Okay, what confirms it? It could be a Fibonacci achieving, it could be a Fibonacci level achieved, a harmonic level achieved at a time point, let's say. It could be add another indicator. It could be an oscillator reading. It could be what I alluded to before, but it's a very specific model, something called the price spiral model, which transforms Fibonacci ratios to corresponding dollar amounts. To the extent you see price action that exceeds a certain threshold that historically you've seen when you've gone back and checked, and it might be market specific, 200 years of data for what we call, let's say, a primary cycle, a super cycle, a minor cycle. What are the conditions or the average moves for each of the waves in a market cycle of 8 waves? When you see a price action or a price trend exceed that, that's a piece of information, albeit not definitive, that would go some ways towards giving you greater confidence that in fact a given trend has ceased and the new trend in the opposite direction has commenced. That type of relationship and observation and phenomena might be in the, generically speaking, what the types of things you would look for to confirm that a market state is one thing and its future extrapolated state would be something else. Also a point and figure chart. Yeah, point and figure charting was the one of the very first things I did at 24 years old. It's an older form of analysis. It has its benefit. All forms of tools and analyses have their strengths and weaknesses. So yeah, I would put in a vote of confidence and support and be a proponent and a supporter of something like point and figure merely on the cause of numbers. So few traders utilize point and figure, and as such, to the extent you incorporate in your toolbox approaches, methodologies that are foreign to the majority of your competitors, the trader on your left and the trader on your right, is the extent to which you're probably probing an attribute of the market that is left undisturbed. And to the extent you are touching on a feature or a component or a facet of the market that the majority of traders are not, is the extent to which you're likely to see it from a different wavelength. You're going to extract a different piece of information. And to that extent, you're likely to trade it differently. And to the extent you present an order, which is a type of information in and of itself, to the market, is the extent to which you're going to improve your odds for success. So that's my long-winded explanation to say I would be a proponent of point and figure charting. I don't do it much now, but it was one of the very first things I learned when I was 24. Okay. Let's see if there are any other. Point and figure chart can estimate how far a market is going to go. Good question. I don't know. I don't remember. It would not be in terms of a price, because whoever asked that's very specific. What you're really asking me, to generalize that question, you're asking how effective is something like point and figure at price targets, at generating a price target. To be honest with you, I don't recall. I do recall it's very effective insofar as the preceding question of ascertaining with a certain amount of confidence that a given move has ended and a different type of price action is about more likely to ensue. The second question is can we use point and figure charting to project in advance the extent of a move, what a price target? It's been a while since I've used it. I honestly, you got me. I don't recall. I am not certain. I do know it's quite effective in establishing a state for the market and whether or not the state is more likely to change or shift. Insofar as price targets, Fibonacci, harmonics, I would say, other types of things are, gaps, chart pattern analysis. Other things are more germane and relevant and more directly, even something like pivot points, R1, R2 stuff, R3 and all that stuff can more directly. I know that, and there's all sorts of things that will do that. I use harmonic analysis in certain ways. I use timing indirectly, although it doesn't speak anything. Again, the question is price targeting. Fibonacci goes a long way to help me there, but it's not the only thing. Candle formation will sometimes, that's more of an indication of a change of direction, but it can also have indirect applications for projection and price targets. All right. I measure the base and it, let's see, what's another question. Do I measure the base and it will give me a guesstimate? Have you looked at the, yeah, Wyckoff is an important, yes. Again, guys, yeah, all I talked about today was very, very, very sub-special. I'm two things. One thing really, I just wanted to present my rotation based on time periods that I've projected. And then to kind of titillate and present a plausible scenario, I overlaid some ideas on Elliott. Yeah, I taught Wyckoff, and it's one of the it's probably the, early on, when I started, again, I started without a background formally in finance, so I did and looked at everything I could. Wyckoff was certainly one of them. What was differential, or what created a differential for me served as an accelerant to propagate of the propagation of my own individual learning curve when I was very early on, starting as a broker at Merrill Lynch, was a guy in our research department gave me a book on cycles, and kind of got me into the methods of Gann and people like Gann and Robert Krauss and others, Jensen. Curiously enough, J.P. Morgan understood the implicit importance of timing. Morgan said, if you want to be a billionaire, not that you or I might want to, I'm not, but not that you might want to be, or if you do, he said, you can be a millionaire without the incorporation of market timing. If you choose to be a billionaire, you must look at time. J.P. Morgan said that. I thought that was fascinating. It got me intrigued. So, but yeah, I understand and teach and use and think about Wyckoff methodology as well. Someone's saying, do I measure the base? I'm not sure what you mean. Yes, you can. Can I measure the base if 0.2, okay, so let's see, the base at 0.2 suggesting, and if it extends much lower, which it could, whoever is posing this question, because wave 2s, if this is a wave 2, by the way, it could go all the way down to this level where C is, which is, hold on, let me see the price that is. That's at 2015. The level of C is approximately where, in other words, if we were to have a retracement of the current move exceeding number 2 and all the way go down and retrace 100% of wave 1, that would be a price level of 2015, approximately, based on I just looked at the price axis on the right. If 0.2 were to extend much lower, does that throw the other points off? Not, yeah, everything. Yeah, it would just, yes, clearly. If it does, you would start there, but not necessarily, is the more precise answer. In other words, starting with the simplest first and then layering in details, to the extent we have a deeper ending point for wave 2, let's assume, wherever it is, you would just shift downward on the vertical axis, everything with wave 3 would start from that level that much lower, and you would shift it. Now, the question that begs another question. Your question is, would it throw the other points off? It might. In all probability, my answer would be yes, but not necessarily. Suppose wave 3 starts from a position further below, further back. If 3, though, exceeds larger than my theoretical, if the degree of excess is more than enough to offset and compensate for the deeper than I expected wave 2, then it might, by coincidence, end up at exactly the same level. So you got to count that into, you cannot discount that possibility. But yes, in principle, as a starting simplistic approach of thinking about this, clearly one can imagine, to the extent there are what people like, Gann would say are inertial overflights of motion. You hit a price target, I do it, but sometimes, he would generate a target to the penny, and sometimes it might pass through, by a couple of cents based on an event that occurred that instant in the news, let's say. And, these are frictional forces. Think of all of these things. Everything we do analytically is merely a model, which is a collection of ideas. To some cases for some markets under some conditions, the market in the real world more closely adheres and tracks it, it is a perfect superposition. At other times, it still more or less follows as a template or as a guiding track, but it makes deeper excursions away based on a myriad of an infinite number of possible variables out there in the universe surrounding the interaction between our theory and our models and what the actual real market does. So we have to take that into consideration. That's where the psychological components, namely, one, flexibility in our thinking, in our capacity to get up off of a game plan that you might have thought or strategically set yourself on based on the degree of a mental investment you've made in a belief system, your capacity to immediately, on a moment's notice, abandon that and adapt an alternate strategy. Easy to think about when we're a couch potato sitting back when our financial energy, our money, is not in the line. Not necessarily so easy, simplistic conceptually to consider. But I don't know that it is. I would submit it's more challenging and of greater difficulty from an ease of actualization to effect in the real world, because money is at stake. And so we might have an attachment to a particular outcome, and so there may be a degree of hesitation and a countervailing force that would make more difficult a simplistic idea to actually effect and do and follow through on. This process of being profitable is filled with myriad complexities. Okay, if point 2 extends much lower, does it skew? Yes, it has the potential to. Yes, clearly. Next question, Hurst cycles. J.M. Hurst. Yes, I do. Market timing and cyclical analysis is my area of research. Some of the Hurst consideration and theoretical ideas are embedded in what I presented. I didn't go, and we don't have time, certainly, but J.M., he did tremendous researcher. Yes, so I do take that into account, Gregs. All right. Any other questions before we sign off for today, folks? I appreciate the questions. Great questions. I love the feedback, and it shows that I'm speaking to, I know my audience by your questions, and you're somewhat astute, I would say. So that keeps me on my toes analytically, at least. So hopefully you've gotten something out of this. If you'd like to know, it's hard in the context of an hour plus or so presentation to go into the degree of detail. Thank you, Dan. I appreciate your feedback, and thanks for attending. And any further, more detail, any one of these questions we can elaborate on for, ad infinitum. So again, it's merely just to kind of give you a semblance of my ideas, latest, and we understand going forward, moment by moment, day by day, we have to make adjustments, but at least we have a starting point, and it serves as an initial template. Okay, folks, if you require additional information, again, here's our contact information. This is our standard slide, our advertisement. I don't, from time to time we have raffles and discounts. Peter Newman is the contact person. He handles all of the internal affairs and so forth. So if you'd like to, if you'd want to know about some of our teaching programs, our webinars, we recorded today's presentation as we always do, and we have other mentors that specialize and focus on different things, different types of analysis. It takes all kinds to make the circle. So if the type of stuff that I'm doing doesn't resonate or is not of interest, I don't do fundamentals primarily. We have other mentors that focus more on the fundamentals. I ironically started my career there. The very first book I read, Fundamental Analysis by Benjamin Graham, at 24. It took me more than a year to struggle through it, but I don't do anything like that now. Glenn, am I a primary swing trader? Now, but I earn most of my money day trading in the E-mini and Forex pairs, currency cash pairs. But I enjoy swing, position, all of the above. I do options, short-term, everything. The only thing I don't teach, not because I can't, I just alluded to that, I'm just not set up. I don't trade off the news like, a report's coming out and I'm going to put on a position in the bonds in anticipation of the swing on interest rate. Or I wouldn't try and forecast what Janet Yellen and the Fed is going to say or something like that. I did that years ago with inconsistent results. So I primarily start with the technicals. That creates more or less a certain sense of what the most plausible courses are for a market, and then I incorporate kind of in a leisurely manner my awareness of what fundamentals are in an obvious sense. Like next week, I know everyone knows we've got the Brexit referendum on Great Britain. So I'm not oblivious to that stuff, and certainly these issues will affect the Forex sector and all financials indirectly. So clearly you'd have to be living under a rock to not be aware of all the events news-wise and what their corresponding effects are on the markets. But I start primarily with the technical approach. And I can swing trade and position trade. I enjoy I'll never forget my second position on Wall Street. I worked at a company called ICS 110 Wall Street, New York City, and I made a mistake. I put a protective stop in on an options trade, and our head trader, who was a woman who worked on the floor in Chicago for years and then became our head trader, came out of her office screaming at me, "Why did I put the stop in?" And at the long shot of this, she said, "What type of trader do you want to be?" And I didn't even know the question. I just knew I wanted to be successful and make money. And her girlfriend pulled me aside and said, meaning she was implying that I want to be a swing trader or a position trader. I don't know what it had to mean, but no, I do all of the above. So there are benefits to longer term swing trading, let's say, or a swing trade versus short term. I happen, for different reasons, under different circumstances, given the scenario, to appreciate all of the above. So again, guys, I got to run, but if you have more questions, you have our contact information, 800-339-8588, or the website. Again, the contact person for me is Peter Newman. It's been a pleasure. I wish you the best, and until next time, wish you the most profitable of trading.